All right, welcome to the Explainer. You know, in our field, there's a big difference between just being a manager and being a real strategic leader. Today, we're going to dig into the tool that makes that difference. It's time to stop talking about simple payback and really get into the power of life cycle costing.
So let's just get right to it with a question I'm pretty sure everyone listening has dealt with, right? How many times have you had this amazing, high-impact project only to see it get killed because the simple payback was, a few months too long? It's so frustrating. That metric is easy, sure, but it completely misses the point. It hides the real long-term value we're trying to deliver.
Which leads us right into our first big topic. We've got to reframe this whole conversation. It's all about getting our organizations to stop obsessing over the upfront price tag and start thinking about smart, long-term strategic investments.
And lifecycle costing, or LCC, is exactly the tool for that job. It's how we show that what we're doing isn't just some minor operational tweak. No, this is about driving core business goals. With LCC, we can build a rock-solid case that our projects directly boost long-term profits, give the company a real competitive advantage, and actually justify those big capital investments that finance is always looking at so closely.
Okay, but to make that case, we have to speak their language. We have to talk finance. So let's just do a quick run-through of the key terms, the stuff we need to know to build a business case that's absolutely bulletproof.
So first, LCC itself. Yeah, we all know what it is. It's the total cost of ownership, right? It's not just the purchase price, it's everything. Energy, maintenance, even getting rid of it at the end.
And you can't really do LCC without getting the time value of money. The whole idea that $1 tomorrow isn't worth $1 today. We have to discount those future savings to build a case that holds up right now. That, of course, brings us to net present value, or NPV. This is really the ultimate test, isn't it? If the NPV is positive, the project makes money for the company. It creates value. That's the bottom line. That's what the C-suite actually cares about.
And that discount rate we use to calculate it? Well, that's the MAR, the minimum attractive rate of return. Think of it as the company's internal hurdle rate. Our projects have to beat that number just to get in the game.
Okay, that's enough of the financial theory. Let's make this real. We'll look at a classic example and see just how LCC completely changes the picture.
So we're going to look at that classic decision. Do we go with the standard efficiency motor or spring for the premium high efficiency one? I mean, this is a choice every single one of us has to make over and over again in our facilities.
Now, here's the number that blows the whole first cost argument out of the water: 96%. For a typical industrial motor, a staggering 96% of its total lifetime cost is not the price you paid for it. It's the electricity it's going to guzzle down year after year. And this table just lays it all out plain and simple. If you only look at the initial cost, sure, the standard motor looks cheaper. It looks like the smart buy. But LCC forces you to see the whole picture. And in that picture, the high-efficiency motor isn't just a little cheaper. It's dramatically cheaper over its life. And when you show them this, the right financial choice becomes, well, impossible to argue with.
And listen, this is not just a motor thing. This exact same logic works for everything we do. We're talking massive HVAC upgrades, waste heat recovery, even something as basic as how thick the insulation should be. In every case, LCC is the tool that points you to the smartest financial move.
Okay, but let's be real. The world isn't a neat and tidy spreadsheet, right? To build an analysis that actually works, one that's truly robust, we have to think about all the messy stuff, all the pushback we know we're going to get.
You know what I'm talking about. We've all been there. Trying to get accurate data, trying to figure out some insane utility rate structure, fighting for every dollar of capital, and then getting hammered with questions about where energy prices are going. Facing these things head-on isn't a sign of weakness in your analysis. It's actually the first step to making it completely bulletproof.
And this is a really important mental shift. Think about it. The energy savings, the kilowatt hour, we can calculate that pretty precisely. That's a controllable variable. But the monetary savings, that's going to move around with market prices. So LCC, when you do it right, isn't just a calculation. It becomes a way to manage that financial risk over the long haul.
So, what's the pro move here? It's sensitivity analysis. This is the key. Instead of walking in with one single number, you show a range. You say, okay, here's the NPV if fuel costs go up 20%. Here's what it looks like if they drop 10%. When you do this, you're proving the project is a solid bet under different conditions. You're replacing their fear of uncertainty with confidence in the project's resilience. And That's what gets the CFO to say yes.
So, let's bring this all home. How do we put all this into practice? Because really, getting good at this framework is what takes us from being the person who manages the energy systems to being a genuine strategic partner in the business.
It comes down to these steps. When you follow them, you're not just walking in with your hand out asking for money. No way. You're presenting a fully vetted, professional investment proposal. You've quantified all the cash flows, you're using their metrics, NPV, IRR. You've factored in all the real-world stuff like taxes and incentives, and you've stress-tested the whole thing. This is how you build a case they literally can't deny.
And that's the real power of LLC when you get right down to it. It completely changes the story. Our projects stop being seen as just another cost to be minimized on a spreadsheet. They become strategic investments to be maximized. They're opportunities with real, quantifiable returns that make the company more profitable and more competitive.
So I'll leave you with this question to take back with you. Now that you're armed with this way more powerful way of justifying projects, what's that one big, high-impact project you've been wanting to do? The one that maybe got shot down before because of simple payback. What investment are you going to go champion for your organization now?